and welcome to the stock-specific class here for Thursday, July the 6th. As always, if you have any questions during the week or any questions I don't get to here in the live class, make sure you send those to Jerry at TradersPro.com. I have a little bit of a market sell-off today, but not unexpected, although it's happening kind of a little bit later than I was anticipating. I thought with that bearish inside week I talked about last week that we would have seen it sooner, but we did rally a little bit last week on that Friday that kind of took out that bearish momentum. But again, sometimes some of those bearish candles start to show up. Sometimes they predict the drop, and sometimes they show up a little bit early, and the rally lasts a little bit longer before the drop happens. And I think that's kind of what we're seeing right here. But a lot of this is kind of fueled by the rise in rates. We'll look at that here in just a second. That's kind of been the reason for the selling today. And that could continue to be a problem. And we need the markets to pull back a little bit. We've talked about this in those previous classes that the markets are getting a little bit stretched. They need to pull back a little bit to create, to not only consolidate the move, but also create better entry points into the trend. We don't want to chase the trend right here with a lot of the, particularly the leading stocks, kind of stretched a little bit. As far as the direction alerts, I don't see anything that's extreme yet. Momentum is getting close to that extreme range, but it's still not there yet. And with today's pullback, remember these update overnight. With today's pullback, they'll probably move back to the left a little bit. But bottom line is they're not showing that near term that we're extreme. Now, again, there's a difference between being overbought in the near term, overbought in the longer term. I'll show you what I'm talking about when we look at the individual charts. But in the very near term right here, we still could push higher if we wanted to before becoming more of that, getting into that more extreme reversal risk area, the extreme overbought area in the near term. Brett, same thing. And obviously sentiment is still, it should be over here in the extreme range right here. This is, I think it happened last week too, where we had a little bit of a glitch on that. Anyway, it's been pretty to that far right side for a long time. Buy-sell ratios still showing the same thing too, not any sort of extreme buys outpacing the sells a little bit, but now we're seeing it move down a little bit. We've been in this kind of tight range for a while, but like I said, nothing extreme there that would indicate that we're overbought or oversold. Same with the sentiment indicator. Now it wouldn't take much to push higher. You can see right here that if the markets did push a little bit higher from here, and we are seeing a little bit. Even though we're down today, if you look at we'll look at the candle here in a second. We're off the lows of the day, so there is still that buy the dip mentality that I'm kind of seeing out there. And if the market did push, continue that tomorrow and maybe into next week, it wouldn't take very long to get to that extreme range, overbought range. And I talked about this when I was talking about that bearish inside day last week, that inside candle. We'll look at that here in a second again. But that even if we did push higher, again, you're just pushing right back into an overbought condition. It probably wouldn't last very long, and you're still right back into that corrective mode, and the markets have done that a lot this year, where they kind of have really been and I think it has a lot to do with the crowd expecting certain things from the market. The market will tend to not do what the majority of the people think it's going to do. So if it becomes very obvious that the market should be going up, it's going to go down. if it becomes very obvious the market should be going down, it's been, at least this year, it's been moving sideways to up. And that's what makes this kind of maddening sometimes, is that, you know, you look at things and you analyze things and you say, boy, based on what I'm analyzing, the market should be doing this. But that's why it's a market. The market is never going to allow you to know exactly what it's going to do, and that's something you just have to get used to as a trader. If you think there's a software program or a guru you can follow, or analysis you can do that's going to tell you exactly what the market's going to do, it just isn't going to be the case. And so, and you talk to anybody that's been doing this a long time, and it's almost kind of a, I don't know if you call it an inside joke or what have you, something like that, where anyone that's been doing this a long time just knows they get used to it. It's kind of, you kind of laugh about it, that you know, you say, you'll almost hear anyone that's been doing this a long time, you always hear them say, boy, the market should be doing this, but because it's so obvious, it's probably not going to do this. And the reason why they come across that way is because, you know, that's exactly what the market does sometimes. It will do the lower probability move enough times to make sure that you can't have complete confidence that it's going to make a certain move. Now, that doesn't mean that we can't still you know, see the trend and recognize conditions, and you know, it has to do the higher probability move most of the time in order to well, just, I mean, it will do the higher probability move most of the time, but it has to do the lower probability move enough times to make sure that everyone's not you know, so confident that you bet everything on that, and you're going to be right every time. So it's just one of those things that you know, it can be maddening sometimes and frustrating sometimes, but you tend to embrace it and just get used to it. And this year, it's just been one of those weird years that it seems to be happening more often than not, that the lower probability move is taking place. But like I said here, it wouldn't take very much to get that into that overbought area. Let's take a look at the charts here, and you can see what I'm talking about as far as being off the lows of the day. We did gap down. Here's the S&P chart, and we see we opened lower. We traded all the way down here. The Dow is down about 500 points. It's down now about 350, so it's recovered a little bit of that. But you can see that when it reached these levels down here, dip buyers came in and stepped up. Now, that doesn't necessarily mean that it's going to push it right back up again. Usually you like to see that reversal, that kind of bullish reversal after a drop. So after you've had decline, you see that tends to work a little bit better. You get a hammer formation, or you know, see the buyers come in off the lows. We really haven't dropped. We were at the highs up here, and we had a one-day drop. You get a one-day drop like that, it tends to be less reliable. It doesn't always signal that you're going to go right back up again. But just be aware of that. That this pattern tends to fail a little bit more often, and that's why it's not only being able to read the candle formation, but the context is always important. Where's that forming? You know, and like I said, if you had a decline and you get a day like today at the bottom, it tends to have a stronger signal that you're going to be moving up, or that you could be moving up off of that. Also, always keep in mind that anytime I'm talking about candle formations, they're the candle themselves is very short-term in nature, meaning all it's doing is basically predicting what could happen tomorrow or within a couple of days. It's not, the candle itself is not predicting a long-term move. Now, you can combine what the candle is showing you with chart patterns that could be predicting a longer-term move. You know, I always talk about this with, you know, if you have if you have an uptrend and then you're pulling back in an ABC, and then at the bottom of that ABC you get a hammer candle formation. The candle formation is saying we should be moving up in the next day or two, but that's all it's telling you is a very short-term move. But you combine it with a longer-term trend. The stock's been in an uptrend. You're seeing what looks like an ABC correction. We should be getting a longer-term move out of that, and that candle is signaling that it should be starting right now. That's how you can kind of combine the analysis to project a little bit of a longer-term expectation. But the candle itself is always very short-term in nature, and so I think that's always important to remind people that, because I see it happen all the time where people look at candle formations, they get excited because it really when you learn how to read price action, you feel a lot of times like you know what's going to happen, especially if the price action is very clear. That candle is very clear, very strong. You get a lot of confidence in what's going to happen next, but then you can take that a step further and start making longer term projections off of it. And if you're not making those longer term projections off of the chart pattern or something else, you're just basing it off of the candle, you'll probably run into a lot of problems. It could be a big mistake. Or it could depend on where you're seeing the candle as well. Or like I mentioned, if you're seeing it on a weekly chart, it could be predicting a weekly, the next week could be down or up based off of that weekly candle. I'll tell you what I'm talking about when we look at it. We can't pull up weekly candles on this charting service here on TradersPro, but we can on another charting service, and you can make a little bit longer predictions off of those candles sometimes. Although we saw last week that it was a reminder that none of these candles work perfectly every single time. We didn't get the drop this week that we were expecting, or last week that we were expecting off of that previous week's candle. All right. So what does it mean as far as where we're at here? Well, actually, let's go and take a look at that weekly chart here. And when I go to a weekly chart, what it does is it basically, we're looking at, let's go to the SPX so I don't have as many lines drawn here. We're looking at each one of these candles represents a full week of trading. And this is what I was talking about a couple weeks ago, where we had this big bullish candle, and then we had this bearish inside candle right here. This was predicting that we should have gotten a decline that next week off of that, although you always have to allow for a pause week or pause day if you're looking at the daily candles. But last week, it actually broke out above that previous week's candle. So this actually, when we had that big move on Friday, it pushed us above here, and it basically wiped out this bearish momentum that was created by that inside candle. Now we could be getting another inside candle to this week if we're flat or down at all tomorrow being the end of the week. It'll create another inside week, and that's what I was talking about. That even if we did break out of here, that this could just be an early signal that, hey, things are slowing down. The trend is slowing down. There's some selling pressure that's starting to build. And now it made sense a little bit that we rallied last Friday. I talked about this last Thursday that, you've got the end of the quarter. It was not only the end of June, the end of the month, but you had the end of the quarter. These big fund managers they set out those quarterly reports. They want their clients to see that they're in the stocks that everyone's talking about. And everyone's talking about Microsoft and Apple and Nvidia and AI stuff, and so they want to show that they're in those stocks. So it made sense that those stocks weren't going to sell off in a big way before the end of that quarter. But now the quarter is done. those stocks have been overbought. They've been moving up a little bit too far, too fast. Now they can sell them and take profits. And I wouldn't be surprised if we start seeing a little bit of that weakness in those stocks that have had those big runs lately. They can't maintain that forever, and so they're really due for a pullback. Now, trying to predict exactly when a pullback will take place can be difficult, because things can stay irrational or overbought for a long period of time, or a longer period of time than you think they should. But at this point, it would make sense that they could, that now they're kind of free to be able to sell some of those shares. Now that quarter is over, they can send out those quarterly reports telling people what they've owned over that period of time. So we'll see if that ends up taking place. Now, another dynamic that we're seeing today, and part of the one thing I look for. Let's go back over to one thing I look for when I'm expecting a pullback in the market or expecting a rally is, especially a pullback, is you need to have a little bit of you need to have a trigger. You need to have a reason to sell. And again, this all kind of ties into human nature. If you think about running a fund, imagine yourself running a fund, and you've got a boss, and you've had Amazon and Apple and Nvidia and all these stocks make this big move, and as a trained trader, you need to take profits. You can't just let them run forever. They're extended. They're getting overbought. The valuations are getting a little bit rich. But if you start selling those shares, excuse me, and those stocks keep going up, what's your boss going to do? He's going to come in and say, "What are you doing? Why are you selling the shares?" And if you don't have a good reason as to why you're selling the shares, if you're selling, "Well, I just thought we'd take some profits off the table," he's not going to be happy. Remember, again, it's one of those weird. It's a weird phenomenon that sometimes you can get more upset with missing additional profit than you can with a loss. I don't know why that is, but it's just one of those things I've come to discover as a coach over the years, and a little bit with my own personal trading. But it's just weird that people will get more upset that they could have made an additional $1,000 on a trade if they would have stayed in one more day than they are with having a $1,000 loss. It's a weird thing. But so knowing that, though, it makes sense. You need to understand that to understand what's going on with these big fund managers. If they get out and they don't have a reason to get out, they can't give a good argument why they're selling, and that stock keeps going up, they could be out of a job. They get fired, and so that brings in an additional pressure into their decision. It isn't just about doing what you need to do as a trader. It's about, hey, I got to make sure my boss is satisfied with what I'm doing. And so that's why whenever markets do something, I always like to turn on the TV and find out what they're talking about as the reason why. It doesn't it doesn't mean that that's going to be my decision or be the basis for my decision. I got to base my decision on the chart and the price action. But I'm always curious to know, is it a reason that I think could be significant enough to, if I was a fund manager, would that be a good enough argument to explain why I'm selling, or particularly why I'm selling? Buying is a different story. It's usually not it's a different kind of emotion there. Not much different, but it tends to be that selling. If you sell too early, people have lost their jobs because they sold too early. It's just a weird thing that can happen. But so I like to hear kind of what is the trigger, what is the reason, and right now what the market is talking about today is rates, particularly the 10-year rate. Now, sometimes in these updates, you'll hear me talk about things, and we'll focus on something for 2 or 3 weeks, and then we'll get it out of the rotation. We won't even talk about it again after a while, and that's because the market tends to focus on certain things, at different periods of time, and you have to be aware of what it's focusing on because it's relevant. It's going to be, like I said, it's going to be that reason why the buying is taking place or the selling is taking place. What's kind of the reason why the buying took place a few months ago? It was AI. That was the big push. Anything AI was going up, and that was the reason. Okay, you need to know that because then you can kind of focus your efforts on. It's not going to last, may not last forever, but that's where the focus is. And so, the path of least resistance is going to be to focus on what the market is focusing on. I mentioned this before that several years ago, the market was focused on Europe and what the Europe markets were doing. And that's how we were going to trade based on how they were trading. And then now you don't ever hear the European markets mentioned on CNBC or anything like that. Not that they're not important. It's just that that's not what the market's focusing on right now. But right now they're focusing. The big news today is rates, and particularly the 10-year Treasury rate. Here it is, right here. I got on a chart here we can look at. And I was talking. I was looking at this earlier in the week, and yesterday, in fact, we were down below 4%. And I just knew that the market wasn't reacting very strongly. We were close to 4%. We were at 3.95% or 3.9. I think it was like something. I can't remember what it was. It was like 3 point. Well, I think it was 3.9. And the market wasn't selling off in any significant way. And my thought process was, well, that's because it's not yet at 4. It's important. It's important to understand round numbers. People in grocery stores and things like that sell things, understand the pricing, the psychological aspect of prices. You're more likely to buy something that's $2.99 as opposed to $3, right? Why? It's only a penny more, but $3 that's a 3. You see a 3 here. Here you see a 2. Even though it's only a penny cheaper, it has a psychological effect, right? And so the market wasn't reacting because we were at 3.9%, even though it was starting to move sharply up right here. But what happened today? As soon as we hit 4%, the market freaked out because it hit that round number. Now, what's going on here? Why is the market even focused on this? Well, we've had this big run up in the first half of the year, right? It's been almost historic. It's one of the top 10 first half of the year moves in the market that we've ever seen. And so what's going on is, again, trying to get in the mind of these big fund managers because they're the ones that move the market. What they're looking at right now, and the reason why rates are going up is because the Fed is still talking about hikes, and we had Fed minutes came out yesterday, and it reiterated that. And so what the big fund managers are looking at right now is, okay, we've got an overbought market that's had a historic run the first half of the year. What is the likelihood it's going to continue that? Obviously, the best returns are going to be in the market. The market has the ability to make to be up 20% for the year, or 15% or 10%. If you're looking at more of a guaranteed return, it's going to be lower than that. And right now, the Treasury 10-year Treasury is at 4%. I can get basically guaranteed 4%. If I have my money in a 10-year bond right now, okay? So what they're analyzing here is, okay, is the market likely to go up? If they think the market's going to go up another 10% by the end of the year, then stay in the market. But because it's had a huge run up in the first half of the year, because bond yields are so high right now, now they're saying, okay, maybe I should be going for the guaranteed 4% and not risking that the market's going to go higher, because it's probably less likely to go much higher from here through the end of the year. Now, I'm not saying it can't end up higher, but you're probably going to get a pullback, and then it'll maybe rally into the end of the year, and then overall, the market will be up, whatever percent, 10% or something like that, and you would have been better off in the market, right? So it's almost like you're playing the prices right, and you're saying, okay, either you can take what you see right now, the 4%, or you can get what's behind door number one, or whatever, right? It could be the brand new car, or it could be the patio furniture, but it could be the brand new car. So do you take what you see right in front of you, or do you go with what's behind door number one? That's kind of what these fund managers are doing right now, and a lot of them are considering taking what they see right now based off of the circumstances. And if you want to keep that prices right analogy going, maybe the contestant right before you already won the car, so you know that the car, there's probably not a second car to win. It's probably going to be the patio furniture, and so you're going to take the 4% that you see right now. So that's what the market is. That's the reason for the selling. Okay, that's where a fund manager can justify that. They can say, hey, I'm getting out of Apple today, and Nvidia and some of these stocks, because they're overbought, and I can get this high rate of return in with a 10-year bond right now. Now, again, is that the strongest reason to sell? No, because again, if it turns right around and these bond yields start dropping and the market starts taking off again, they've got to explain that to the boss, and they're probably going to be chasing right back into Nvidia and Apple again to make sure that they can tell them that they still own them. But as of right now, that's kind of the reason why we're seeing the selling, and I just wanted to explain the kind of the why behind that. Why, if you've been watching CNBC all day and they're talking about bond yields, and you're like, well, what does that mean? I don't understand why that would be a reason why the market is selling. That's why is that's the analysis they're doing right now. Is they're looking at the rest of the year and how far we've come, and boy, we've got this high bond yield right now. We can just jump into and grab that. What we can see is a guaranteed return or right in front of us, and skip the risk of door number one, choosing door number one, and what could be behind door number one. All right, so now getting back to our charts here, what kind of chart pattern are we forming here now? And last week I was talking about this. I felt like this was wave A. I felt like up to that point, before Friday, I felt like this was forming wave B, and I thought we were going to have wave C down. Now that we came all the way back up to here, it could still be an ABC. We call that a flat ABC, where wave B comes all the way back to the beginning of wave A. Now, usually when that happens, wave C will tend to end at the end of wave A. It'll be more of a flat correction. And I don't know if that's deep enough to really see. Let me show you what I mean by long-term overbought as well. If we look at, I'm going to switch this over to a weekly chart here again. Let me get rid of some of these lines here. So this right here, these are moving averages. This now, because we're on the weekly chart, this would be the 20-week moving average, and this would be the 200-week moving average. The 20-week is more of shorter term in the context of a weekly chart. It would be real short term, but this would be very long term when you're looking at 200-week moving average. But what tends to happen is stocks will tend to move, and they get away from these averages, but then they tend to come back to them. They tend to revert back to the mean, so to speak, and you can see how far away we are from that 20-week moving average, and we're really far away from that 200-week moving average. You can see on the way down that every time we got way below that 20-week moving average, we had a tendency to come back to it. Here we got pretty far below it, came back to it, and then you get a little bit too far above it, it comes back to it. And now this is not an exact, you're not going to use this to say, oh boy, it's going to move back today or tomorrow, but you just kind of recognize when I keep talking about, boy, I can't see it going too much higher. This is what I'm talking about, because you're already stretched. You're already a pretty far distance away from that mean, and it has a tendency to revert back to the mean. It just becomes a little bit of a headwind for it to go too much further. It's kind of like if you imagine the market having a rubber band attached to it, when it gets too far down, it's stretching that rubber band. It's going to snap back at some point. When it gets too far above it, it's going to snap back at some point. That's what tends to happen, and so we're definitely in a area where we could expect that to take place. Now, you flip back over to the daily chart, and from a near-term standpoint, that's what we saw in the direction alerts. We're not too far away from that 20-day moving average, but we're still pretty far away from that 200-day moving average. And so, even if we rallied back up, we're still in an area where we would expect to pull back. Now, we don't have to come all the way back to it. I'm not saying we're going to drop all the way down here, but if this is wave A, wave B, wave C, you can see if it ends right here, it's still pretty far away from it. It wouldn't have corrected it enough. And what I was looking at last week was, if that's wave A, this is wave B taking out that Friday move, and we had wave C coming down down into this area right here. Not only would it come back to this breakout area, but it would be a lot closer to that 200-day moving average, which would really alleviate that overbought condition, and it would be a better entry point for expecting a new move higher. Now, I talk about all the time what I would hope the market would do. It rarely does what I would want it to do, but that would be the ideal area for me to really get aggressive buying, is if we got a decent pullback that would alleviate the overbought condition and give me a good entry point into some of these moves, and make me comfortable getting into Apple or Nvidia or some of these other stocks. Excuse me. All right, so and like I mentioned, with today's coming off the lows of the day, that's another reason why that probably won't lead to anything significant. Now, it could be also, keep in mind, we did come all the way back up here. This could have been a small correction by itself, and this was an impulsive move up, meaning that we could be just starting a correction, wave A, wave B, wave C, or something like that. And so that's another thing that we'll kind of keep an eye on. We don't have enough data to kind of determine that yet. And that's why this week is kind of a throw out week. It's really not helping us much with where the market could be headed. Now, tomorrow we do have a jobs report tomorrow, and that could be significant. By the way, this all kind of gets back to an argument I've been making for a long time, and I'm going to reiterate it here just because there's probably new people who are joining in, and may not have heard it, but and I feel pretty strongly about this, that just understanding, again, human nature, and again, we're not going to base our trade off of this alone, but it's important that this does factor into what creates these charts, and so that's why I talk about this stuff. But I keep coming back to, people that are making the argument right now that, it's going to be a soft landing. The Fed doesn't need to do anything else. We're going to go charging right back up, and the market's going to take off again. The economy's going to take off again. Well, what have I always said? If that happens, what's going to happen is we're going to have inflation's going to take off again. It's going to take off again. Why? Because immediately you're going to plan that next vacation. You're going to now plan to buy that new car, and you're going to start spending. And remember, what kills inflation is the fear of spending. We haven't had any fear of spending. We started to get it. But if that's all we had was this little blip of a banking crisis, and it was the regional banks, it wasn't the big banks, and it caused a little bit of unemployment out there, and a little bit of a slowdown in spending, but then it's ramping right back up again. It's a soft landing. Inflation is going to take off again, and the Fed knows it. And their number one priority right now is to kill inflation. Inflation is the hardest thing to deal with, and it's because of that. It's because you've got to psychologically change spending. And how do you do that? People have to be afraid to spend. Well, what creates that? Pain creates that. It's being out of a job or being close to being out of a job, and just saying, I'm not going on that vacation. We're canceling that right now. I'm not buying that new car. We're going to get by with what we have for another year. I'm not going to do this. That is what will kill inflation. Because otherwise it goes right back up again. But if you've had pain and a little bit of suffering, then you're not going to be, not only are you not going to spend, but you're going to be reluctant to spend even when the economy gets back on track. You're going to be like, yeah, I got a new job. I was lucky I've been out of work for 3 months, but I got a new job now. Okay, I'm not going to plan a vacation right away. I am going to maybe build up my savings again that I lost during that 3 months. But you're going to be afraid to spend. So if you want to know when the Fed's going to be done raising rates, it's going to be when there's pain, and hopefully it's not you individually, because I wouldn't wish that on anyone, but there's going to have to be pain in society that is strong enough that it slows spending for an extended period of time, beyond just a couple of months. And if they don't, again, that's what I'm assuming the Fed is doing. That's going to do, and that's why they're still talking about hikes. They've got to break something. They've got to break something in the economy that creates that fear to spend. And if they don't, they may not. They may just let things take off again. But what it means is that inflation is going to come roaring back, and we're just going to extend this whole thing out another year or more. And that's what happened in the 70s. Again, I don't want to be talking about this. I'd love to think that there's a scenario where there's no pain involved, but I've studied human nature long enough now to know that that's not the case. If we could all be disciplined, if we could all just say, okay, the economy is coming back again. We could have a soft landing if all of us agree not to go run out and spend and buy that new set up that new vacation, buy that new car and all that. We just have the discipline to just not spend, put that money in a savings account. Then that would work. That would bring inflation down or keep inflation down, and you could grow the economy back, and the economy could take off again. That would work. But you tell me, I mean, come on, let's be realistic. That is never going to work, because everyone's going to say, well, if all these other people are slowing down, but I really need a vacation. They don't know me. I really need this. I'm going to go ahead and plan this. They're going to. That's just human nature. That you're gonna take care of yourself, or you're gonna do what you think is best for you, or what you want to do, and you're gonna do you're gonna do whatever it takes to avoid pain for your individual life, and to seek pleasure. Pain and pleasure is what drives human nature, and that's why it's inevitable. And it's sad, and it's scary, and it's not something I love talking about. But I also don't want us to be in these classes, looking at the world non-realistically, and not understanding human nature, and getting caught in kind of the trap. We want to be able to see it coming, right? It may not be pleasant, but at least we know what's coming, and that's what I see. And if we do rebound, just keep that in mind. If the market starts charging forward and the economy starts charging forward, just understand that inflation is going to start taking off again, and enjoy the run again that could happen for another few months, but just realize that all we've done is kick the can down another year, and the pain's coming down the road, and at some point in time it's gonna hit. All right, so boy, I took a lot of time on that. Let's skip down here to TLT. By the way, the TLT is going to show you the opposite of bond yields. So when the bonds go down, it means bond yields are going up. So it has kind of an inverse. That's why this looks almost the opposite of that 10-year chart. But it is significant to point out a support level that we've been watching. Overall, we've been saying the bonds have been moving sideways. We've kind of skipped this analysis a few weeks just because of that. But now we're right at the bottom of this range right here again. If we break below that, that's going to be very bearish for the market, but it would mean that bonds are trending down, and breaking a key support level. So that's something to watch this next week. See if it ends up, especially with the big move over the last couple of days that have brought us down to this level. We'll see this on Tuesday. What ultimately ends up happening? Do we break that key support level that we've been watching for quite a while now? All right. Gold kind of still trending down. Near term, I wouldn't want to own it, but longer term, like I said, I've shown you before, that long-term chart, 10, 15 years, really looks bullish. But I think you get a better entry point if you let it get done dropping here. Oil's been just kind of in that sideways range, not much to talk about there. The dollar is rising, and the correlation is usually when bond yields are rising, it's usually bullish for the dollar. When they're falling, it's usually bearish for the dollar. Now I've been kind of looking at this as kind of a correction. Well, last we were looking at this as a correction for a move down. So this was the start of the move down. Here's the correction, and we'd start trending down. But now we're up above that 618 retracement level. It's becoming more like, and with those bond yields rising still, it's making it more likely that dollar's going to continue to move up. And it could be a gigantic cup with handle formation right here that's formed on the dollar, which would be really bullish. And that could be a little bit more bearish. The market has had a tendency to rally more when the dollar's falling. It doesn't always correlate that way, but it's usually been a little bit more bullish for the market when the dollar's been falling. The VIX, take a look at the VIX on this chart right here. It spiked up a little bit early today. Now, obviously, with the coming off the lows, the market coming off the lows of the day, the VIX has come down a little bit. But we talked about this last week. The VIX was kind of forming a little bit, maybe a little bit of a bullish head and shoulders pattern, inverse head and shoulders pattern. Not surprising that we're starting to move up. Not surprising, especially since we've been kind of flat down here at these very low levels for a while. That was another headwind for the market rallying significantly is the VIX being down so low. It's in an area where the volatility is cyclical. When it's in a period of low volatility, you're more likely to move to a period of higher volatility, and it's looking like we're starting to move to a period of higher volatility, which would correlate to the market pulling back. And because it's just a one-day move right here, it probably is signaling the start of a pullback rather than the end of it. But again, I don't see a strong indication, especially coming off the lows of the day today, that there's still a possibility in the near term it could still try to fight to rally a bit higher. But we're getting very close to getting a decent pullback here based on what I'm seeing with all this analysis here. Chip stocks, we talked about these, starting to look like they're rolling over a little bit. And we're seeing a little bit of a confirmation of that today, actually yesterday and today. With today's drop, it's really kind of signaling a lower high. Now you're looking at this low right here. You had a higher low right here, but do you end up going to a lower low? That could be an early signal that you're rolling over into a downtrend. Now, it also could be that this is just a wave A, wave B, wave C, just a deep correction, and then it takes off again. But in the near term, this is looking like it should be going down. Here's kind of your head and shoulders pattern right there if you're looking at chart pattern there. And chip stocks tend to be a little bit more of a leading indicator. And I like to compare the SMH to the Qs. The Qs are kind of we're fighting to go higher. Chip stocks are showing a little bit more weakness in the near term. That could be signaling that a lot of those big cap tech stocks could be following suit, could be starting to correct. Transportation stocks have been really outperforming. That has been more of a bullish indicator, but they're moving down today. We'll see if that's, again, the start of a little bit of a correction there for the Dow. Bitcoin's in a little bit of a corrective mode after this big run up. I still am longer term bullish on Bitcoin the way I think it bottomed there in November, December. This is just a kind of consolidation. And I think that Bitcoin could continue to go higher off of that chart behavior. Real quick, let's take a look at those mega cap tech stocks. Again, this is something we're not going to do every week, but because the market's been so focused on these, we want to see if they're starting to break down. NVIDIA, it's not huge weakness yet, but just like that, the SMH there could be putting in a lower high. This is going to be a key support level. Does it go to a lower low? It already kind of looks like it is kind of rolling over a little bit. And a lot of these charts look that way, to where they're not quite broken yet, but they're kind of looking like they're rolling over a little bit. Microsoft, again, had this drop down right here, had this impulsive up, impulsive down, and then it's kind of been drifting a little bit more sideways. Again, it's not coming right back up again. The buying is lagging. It's not real strong buying right here. Now, again, it doesn't necessarily mean that it has to go down, but it's starting to look like that momentum is starting to fade a little bit. And it's important to recognize that we're not seeing these break yet. They're not broken charts yet, but they're on the verge. And so once that happens, we want to be able to recognize it, point out in class, and because that's going to be a strong bearish signal when that does take place. Apple, again, down today, but fighting to move higher. It's trading higher than where it opened. There's a dip buyer still in the stock. It hasn't shown much it's still right on that trend line of that rally. Hasn't broken that yet. AMD's kind of broken down already. Had this impulsive move down. It rallied back up to this little support level. Now it's looks like it's rolling over again. AMD wasn't the strongest. It wasn't the 7 mega cap text, but I've added that in just because it has such a big reaction with the NVIDIA news as well. Google, you could make the argument on Google that it's already had its pullback. This is maybe a bullish ABC pattern right here, but again, it's kind of been sluggish as it's tried to rally. Hasn't been able to really take off there. What I would look for here as far as breaking the trend is this trend line right here. It breaks below that. That would be definitely more bearish and would be a signal that the thing is in a deeper correction. Amazon, again, down day to day, and it has kind of broken this little trend line right through here, this recent one right here. So, but still early signs that maybe it's rolling over, but not strong signs that it's rolling over. Tesla keeps going higher. It's down a little bit today, but that was really defying gravity. And Netflix, kind of the same thing, first down day today. So we'll keep an eye on Meta. Meta, same thing, bearish reversal candle. Well, a little bit of a bearish reversal candle today, although you could make an argument it's a little bit of an indecision candle as well. Not showing much weakness yet. But that's why we keep watching these, is because we want to see if they're breaking down. It's hard to expect the market to have a bigger sell-off unless these stocks are starting to show that. But some of them are showing that it could be very, very close. We could be, and it might be that they're holding out this week. Historically, the 4th of July week tends to be more of a bullish week. I talked about that a little bit last week. Doesn't guarantee, you never want to base a trade off of seasonality, but you do want to be aware of seasonality, particularly if it agrees to the chart. Now, in my mind, it didn't agree to the chart this year until Friday, because we had that bearish inside week. I thought, boy, maybe this is the year where maybe we do have a sell-off in the 4th of July week based off of that bearish candle. But it could be an explanation why. Remember, we were looking at the weekly candles. This could be another bearish inside week this week. We were seeing that that it could be that the market's just kind of trying to hang on a little bit, and actually, forgetting that the market's down a little bit today. I'm thinking of coming off the lows, but that maybe we do end up with a down week this week. See how tomorrow ends up. And again, tomorrow could be very heavily influenced with that jobs report in the morning, how it trades. But after what happened last week, where things were looking bearish right up until that big Friday we had, it could be that market charges right back tomorrow, and it changes the look of everything. But overall, it just looks like the market's just trying to hang on a little bit. And we're seeing that on these individual mega cap tech stocks. So I think to expect the market to have a bigger pullback probably won't happen unless we see these stocks break down, which is why we're looking at them right now. We're going through, we have a watch list. We're watching those. We'll take a look at them on Tuesday next week and see if they're showing any stronger signal of breaking down. All right, just a few stocks to go over. Under the the new buys, there's just one on the new buys that I liked, which is this IMCR 92 strength rank. See, there weren't a lot of stocks that had a 90 strength rank on the new buys, and that's one thing to keep in mind when you're using these scans. Is it, if you be aware of the strength rank. If you start getting in the 80s, I'm not saying you can't trade something in the 80s. But just be aware that, I'd have to really love the pattern, the chart pattern, because you're the whole point of using the software is you want to try to stick to that higher strength rank, that use that algorithm that's telling you, hey, these stocks are outperforming other stocks. But again, I'm not saying just buy something because it has a high strength rank. What I want to see is a nice chart pattern with a high strength rank. And if I don't see a nice chart pattern with a high strength rank, that could be a signal that I shouldn't be buying anything. I should be patient. And so that's why we want, but I don't want to just say never get something in the 80s or 70s, because there are times where I see a great chart pattern and it may have a 70 strength rank, but that would be a rare case. And so, I always leave room for, and part of that is because of my experience too. I've done this for 25 years. The software is really designed for someone that doesn't have experience and doesn't want to learn. They just want it simple, and that's would be the simple approach. Stick to high strength ranked stocks with nice chart patterns, and it wouldn't take very long to just learn some basic chart patterns and go with that. You'd want to avoid dipping down, but there aren't many this week in that high strength rank, and that fluctuates. Sometimes we get a lot of charts there, but this IMCR, what I like about this is I have that cup with handle formation. You have the cup and this kind of extended handle. Looks like it's breaking out. You have a down day in the market, but this is moving up. It's a pretty bullish sign. And what I like about these patterns, I can put a stop down below here. Here's where I know I'm wrong. If it is breaking out, it could be taken off in a big way. And so that one looks pretty good. Getting into the individual sectors under construction, I liked. Some of these might need to correct a little bit more. HOV looks like it could be in a wave C of a correction. Wave A, wave B, wave C. So I'd like to see it come down a little bit more. But I've been waiting on some of these construction companies. They've been on a tear. I've been waiting for them to kind of pull back a little bit, and I think if this can pull back a little bit further, that'd be a good, and then start moving back up again would be a nice entry point. So probably this one you throw in a watch list. Aerospace, again, what this is showing you when you go under sectors, it's ranking the sectors. Right now, construction is one of the highest ranked sectors, aerospace, transportation, industrial products. And so what I like to do is see what are the top sectors and then look at the top stocks within those sectors. And I go into the hold section, because what you can start doing with these is find stocks that have hold signals that are in strong sectors, and then you wait for them to go to a buy signal as confirmation to get in. You can look under the buy section. A lot of times, though, these stocks are too extended. They're in their moves already, and I don't want to chase them. So I tend to look in the hold section. So that's a little bit of the reasoning behind going into that. This I like under the hold section of aerospace. I like this. Where is it? Unless I might have gone under the buys on this one. Hold on. I did. This at HXL. So this still has a buy signal, but what I liked about this was it was just breaking out of this kind of triangle formation. So it broke out right here, and then it's kind of been consolidating along that breakout area. Now, it doesn't mean it still couldn't pull back a little bit, but this is a pretty bullish pattern, and I would expect it to move higher. Now, this is one that's a little bit below a 90 strength rank, but not much. But I like that one right there. And then under business services, I like this Bowman Consulting Group, BWMN. 97 strength rank. Again, it might not be done with that. If this is a wave C, it might not be done with that yet. This could be A, B, C. But here again, this stock is at a hold, and you could wait for it to go back to a buy as confirmation. But I also like how it's pulling back to this breakout area. So it broke out of this range here. Now it's back, pull back to that range. If it can hold this, it could take off. And that's why, again, this probably needs a little bit of confirmation. Maybe wait for it to go back to a buy signal or start to move back up again. But that's a nice looking pattern right there. And then keep in mind with our analysis today that the market could be pulling back overall, could be starting to pull back. That's why we spent all that time, is you want to recognize the market conditions and then start to make your decision whether you want to get into something or how much of what you want to get into. Maybe if the market conditions still look like you get a pullback, but you have a nice strong trending stock, well, then you could still get into that stock, but you'd want to limit it to that one stock as opposed to getting into 10 stocks. Now, if the whole market looks like it's going to take off, then you start trying to find, 5 to 10 stocks or something you could get into. You start to look at, are there a lot of stocks you could be getting into and take advantage of that overall market condition that looks really bullish. Another one under business services here is SoFi Technologies, 90 strength rank, but again, this one's also possibly in that wave C. I'd probably wait for that because it could get down probably into this range, and I'd bring it into, there's kind of a breakout area right through here. Maybe throw that into a watch list. All right, that gives you a few consider. Real quickly out of the portfolio, SGML has a little bit of a bullish reversal candle, and my stop is down below here, so I almost got stopped out on this when it came down to this area here. But we'll see if that starts moving back up. The SQQQ, this is that hedge, and with the market down today, I'm going to kind of hang on to this in case the market pulls back. This should go up, but it's offset a little bit of the declines on some of these portfolio positions. Riot down a little bit today, but overall, I like that pattern. It still looks good, and this was tied to that Bitcoin. If Bitcoin rallies, this would have a tendency to rally. MTW is down the last couple of days. Let's see, that's where that SQQQ is. Not much. It's offset some of these declines a little bit. My stop's down below here, so I think it's down below here. So this isn't that big of a deal. Although this is kind of a little bit of a breakout area right here. I'd like to see it kind of hold that area if possible. And wire is down a little bit too. This is kind of based off of maybe moving up the right side of the bull, but this is going to be a key. You'd like to see that support area hold right there. I can't remember if my stop's down below here or down below here. I think I might have had it down below here. Let me take a look at that real quick. $159. Yeah, it's down below here. So there's plenty of room there still. All right. Real quickly here, let's just look to see. Yeah, the market's rallying off its lows, but it's still down overall. See how it closes. But again, I wouldn't look in the context here. I wouldn't look at that as being overly bullish. Could mean an update tomorrow, but I think a lot of that's going to depend on how the market reacts to that jobs report. All right, have a great weekend, everyone, and we'll see you Tuesday when we'll kind of be back to normal next week after kind of the vacation week. See you next Tuesday for the next market update. Bye, everyone.